This is In the Money with Amber Kanwar, and today we've got Lyle Stein of Forvest Canada. Now, he's a Canadian fund manager, and we're talking to him at an interesting time. Canadian stocks are outperforming U.S. stocks, and the Canadian stock market is sitting at a record high. Lyle can go anywhere in the Canadian markets, but increasingly, he's doubling down on commodity stocks, especially dividend-paying ones. Let's find out why. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit dividend-paying today to discover how you can live a life well planned. Lyle Stein, thank you so much for joining me in studio.
You're so welcome. It's good to be here.
It's nice to speak with you again. I used to interview you a ton on the BNN days.
Those were fun. I really enjoyed those times when we spent just dialoguing.
Yes, and we're going to have an hour to dialogue and really get into who you are, what your bent is in the market, and then with that bent, what do you think of these markets? Because it's sort of like everything kind of feels like it's at a fever pitch. So first, let's start with what's your style? What are you chasing out there these days?
Well, in terms of style, I have to go back 40 years when I was learning economics, University of Wisconsin, U of T, and my first job. It was calculating the cost of capital for utility companies so we could raise people's utility rates in Canada and the US and whatnot. But I really learned that the cost of money is so important. And then the risk associated with the cost of money is the corollary to that. So if interest rates are low, it's typically a low risk market, but to enhance an investment in equities, you get a higher return. And so that fundamental difference between equities and bonds has been a part of what I've been doing for 40 years. And I carried it on. I went from this consulting role to the portfolio strategist at Nesbitt Thompson. Got to do the same thing.
And it sounds like, when you tell me your history is that, I feel like I can intuit that you're not someone chasing a 10-bagger over 3 months. You are, you probably like dividends. You look for value in the market.
Precisely. Anything that doesn't pay a dividend, I've seen defined as a speculation. Traditional investing always has a return on your money. And investing, though, is more than just the return on your money. It's the return of your money. You don't want to put $100 down and only get 90. Or even if you're getting, let's say, a 5% dividend on that, and you're only getting 95 because it's down 10%. That's not investing. So what we're looking for is a stable income stream generally, but not always, because there are opportunities out there where the company's growing and they're not paying dividends.
I feel like we need this conversation. If you followed the most recent episodes, we just talked to Rick Rule, who admits he goes into very speculative names that can pay off big. Then we just talked to Eric Jackson, who is leading the charge on what some would call a meme rally. Mm-hmm. And so when I said, Lyle Stein is coming up, I said, it's time for your vitamins now. You've had some candy. And this feels like vitamins for your portfolio.
That's actually an interesting way to look at it. You got your vitamin C and your vitamin D. There's always, we used to say, there's always a little room for Jell-O. If you remember that old commercial, Rick Rule's very speculative stocks, there is room for that in a properly diversified portfolio, but everybody is different. And what might be good for one person is totally inappropriate for the other. And you got to remember that when you're managing other people's money.
And I know 40 years in the business, it varies for different people, but you seem to have a high level philosophy on portfolio construction. The percent of your investments that should be allocated to a certain style of investing. Can you just quickly take me through that, how people should think about a vitamin approach to constructing their portfolio?
Sure, and we'll stick with the C's. So we look at portfolios perhaps different than the traditional asset allocator, where they say we're going to own bonds. Fixed income will be 40% and equities will be 60%. Well, that might work for one investor, but it doesn't work for the majority of people. In fact, when you buy a balanced mutual fund, and I used to run a balanced mutual fund that was quite different than the usual. It wasn't the best bond index and the best equity index. It was, what is the interaction between securities? That's where you really make money for clients and where you preserve capital. And so we think of investing as, remember your Venn diagrams from grade 9 math?
Oh, love it. Let's dust them off.
So you got 3 circles, right? And it's the overlap that is just the market in general. But it's the outsides where you can get unique securities that have different factors than others. And so from that, you can create a really interesting portfolio for an individual client to tailor what it is they actually need in terms of income and growth.
So what are those 3 circles right now for you, like in terms of style or factor?
So we call them comfort, calamity, and children.
Oh.
And there's a 4th one called CRA, but we want to avoid them at all costs because that also impacts
Taxes,
what you're picking. So for the average client, first question we ask them is, how much income do you need from your portfolio? For a young person, probably very little. They're saving, they're accumulating assets. But for an older person, they need income. So we have to take into account how much they need. What's the biggest fear of people? It's a calamity that will impact their income. And so we have to build a portion of the portfolio for calamity protection. The rest is for your children. Because frankly, if you got your income covered and you got your calamity covered, you really don't care because you won't be here when that money might be called upon. So you can be a long-term investor. And that's where you can take a non-dividend paying stock. But the most important first thing is to make that client comfortable with the income that portfolio is generating.
I love that. Comfort, calamity, and children. And I think that's going to come up a lot in the stocks that we discussed. Not surprisingly, we have a lot of stock-specific questions for you, and you brought your best ideas right now. Before we get into the mailbag, though, let's just talk about these markets. Let's first start with the U.S. Anybody can see it. It's an expensive market on pretty much every single metric. There's something called the Warren Buffett indicator, which is the ratio of equity to GDP. And he wrote in 2001, if it goes above 200%, that is a big warning sign. It's at 217%, which is a record. Then I see strategists say, this time is different.
Those 4 words, this time is different.
Yeah,
scariest words in investing. Yeah.
So what do you think? Is this time different?
No. We will revert to the mean. We've gone through a bit of an AI bubble. There's a great podcast on earlier this week that I listened to by a guy named Paul Kudrowski. Talked about that. Wonderful assessment of where we are. And you can see it. Look, we don't own NVIDIA. We had owned AMD as a chip stock because it had better value, but you can't pay 35 times earnings or whatever the number is for a stock that's $4 trillion of market cap. It's just impossible. I mean, I hate to say it reminds me of Nortel. When I was looking at Nortel, it was a long time ago, close to when you were born. But it's the same thing. You can't grow the way people are expecting it to grow and have it compound the way people are expecting to compound.
But I assume since you've sold, the stock has done tremendously well. So how do you guard against, what do the kids call it, fear of missing out, FOMO?
And that's the toughest part. That is honestly the hardest part of investing other people's money, is that you look like a fool if you miss out. And I can go back to Nortel. Remember, Nortel was spun out of BCE. And at the time, I was working for a big institutional shop that had a significant high net worth component. And little old ladies were getting the Nortel spun out of their BCE. And they were excited as all get out because that stock was going to 80, 90, 100, 128 was the all-time high. And then I went, effectively to zero. And yes, there was all kinds of issues. You're not saying
that could happen to NVIDIA.
No, not at all. Not at all. However, the hottest stock at the time was Cisco Systems. And Cisco Systems has never seen the high that it saw back in 2000. And it's now considered a traditional manufacturing company. The average life of a AI chip, as Paul was very quick to point out, is only 3 years. This isn't like putting fiber into the ground or rail on the ground. And so it's a very different kind of world. But psychology driving bubbles never changes. And fear of missing out is probably the most important psychological element there.
And honestly, it takes up so much oxygen that you might not realize that other sectors are doing so much better over, let's call it the last year. That the Magnificent Seven as a group, yes, it's hitting new highs, but in terms of percentage increase, you're seeing better moves elsewhere, including Canadian stocks. We're back.
Canadian stocks have been back because we have two primary drivers. Energy's been strong. It's kind of been flat this year, but it was a leader in 23. We have the banking stocks in Canada, which have benefited dramatically by the reduction in interest rates. Interest-sensitive stocks, they love when rates fall, and rates are falling in Canada, and gold stocks. And the gold stocks have really driven the TSX more than any other market in the world. When you look at it, we're a wacky market. We've got, I think, 12% now in gold and precious metals. The biggest market elsewhere is maybe 2 or 3. And we've got 35% in financials. Both benefited dramatically, hence Canada.
So on a relative basis, the TSX is still cheaper than the US market. But I guess the question becomes, is it expensive for what it is? The TSX is hitting all-time highs as well. It is outperforming. How do you think about that question, whether there's still value and opportunity there?
There's always value and opportunity. I mean, that's the beauty of the market. There's always a good idea. That said, I don't know where gold's going. We have a big position. We'll talk about that later, but I just don't know where that's going to go. I don't know where oil is going to go, but I think $60 is a price which is very hard to find. And I go back to that cost of capital discipline that's overriding the investment process that we utilize here. That cost of capital is very high for the oil and gas industry. It has been because over my 40-year career, they've blown money up for 25 years, and only in the last 8 years have they really got religion. Same thing in the mining sector. They've gotten religion because their cost of capital got too high. Cost of capital in the tech sector today is effectively zero. And you're seeing that with, the Oracle deal to borrow a lot of money to buy NVIDIA chips, to be partners with NVIDIA and OpenAI. It's getting a little circular. Again, I never want to say history is going to repeat, but we've seen this before. We've seen it before in those boom days of the late 90s.
Yeah, that's actually kind of wild. I don't feel like it did knock the stocks down a little bit to see NVIDIA sign fund companies that will then turn around and use that money to buy NVIDIA chips.
Yeah.
That's what you're talking about,
exactly.
that circular process. And that's this kind of stuff that people saw back in the dot-com era.
Yeah, and it's a natural progression. We see it in the oil and gas sector where the big guys buy the smaller guys instead of having exploration departments in-house. We have it in the same thing in the mining sector.
So, it seems like people are worried about that. And it might not show up in the tech stocks, but it's so obvious that it's showing up in gold. Yeah. That's where people are going. And it's where you are. And we're going to talk about stock specifics. But in a very general level, I actually just was poking through the TSX sectors today. And the material sector is up so far in 2025, 76%. That will be a record annual gain for this sector.
Yeah.
And so you must ask the question, is all of that negativity already priced in? And is the risk good news, not bad?
I view risk somewhat different. Every time the TSX goes up $1, it's just added another $1 of risk. Every time it falls $1, it's taken risk out. If in fact you have a long-term view that the market's got a value, as it approaches that value, it becomes more risky. As it falls away from that value, if you really believe it, it's less risky. So here we are in this gold. Some people would call it a bubble. It's getting near 38, 3,900.
I don't hear gold bubble as much as I hear AI bubble.
Well, no, and it's interesting. So, we have a lot of gold. So I'm watching it like a hawk. Nice news is, we've had a lot of gold because it's that calamity. Mm-hmm. It covers that calamity portion. And when we were going into 22, calamity was big. And we bought names there, and the names are up, nicely, really nicely in some cases. But where do you go? So the big question I always ask myself is, where am I going to go with the money I take off the table? Now, there's always a good idea. But if I took my gold money off, am I going to buy A bank stock? Nah, I don't think so. The yields aren't as good as they were. And all around the world, the gold market, there's an interesting article I just read this morning we have a global meeting at Forvest all around the world. Savalis, is a real estate company. They do great global research. Value of all residential real estate in the world today is $393 trillion. Most of it's in China, the biggest lump of it. Canada's, I think, ranks 6 or 7. The value of all gold ever mined is $20 trillion.
So teeny.
Tiny. And a lot of that is getting socked away in central banks. These guys will never sell. So if I sold my gold, it'll probably wind up going to a central bank. I'll never get that money back. If I'm going to sell my real estate, where am I going to put the money? Where am I going to take the gains that have been there for 40 years? What am I going to do with it? Anyway.
This leads me to a good, to my next question, actually, perfectly. I want to know, high level, what are you doing in the portfolio? Are you taking profits and waiting for pullbacks? Are you adding here because you're comfortable adding to the sectors that you own? What does it look like day to day? Yeah,
right now we're cautious, but we don't have as much cash that caution might state. We are, as I said, underweight banks, but we're overweight other dividend-paying stocks. We can touch on that a bit later. But I think from an asset mix perspective, we're not looking for calamity protection from cash directly. We bought recently, and we haven't done this in a while, inflation index bonds. Deflation, inflation, I don't know where it's going to go. Gold will perform well in an inflation. It will do well probably in a deflation. But I want to have some government fixed income exposure. U.S., I won't touch a Canadian real return bond. I'm trying to stay away from anything in Canada. But I bought that with a good real return associated with it. I did buy some U.S. short-term bonds because we do have minimum guidelines in our investment policy statements that have to keep us at 20% in fixed income. So our fixed income, small little portion in tips, small little portion in short-term U.S. securities, and the bulk of it's in preferred shares. Because preferred shares, I can get 5, in some cases 6%, very tax-effective returns. Wonderful.
I have to go back to what you just said. Trying to stay away from anything in Canada, but you own Canadian stocks. I assume you mean stocks that are exposed to what's going on in Canada, the Canadian economy, because we also punch above our weight in terms of Canadian stocks that are actually global stocks. Yeah. So help me understand what you meant by that.
Sure.
And why that is.
Okay, so when I speak of Canadian stocks, they're stocks that trade on the TSX, but basically their operations are not in Canada, or their operations are such that whatever it is they're doing is priced in US dollars. So it's not priced necessarily in Canadian dollars. And the good news is, and take gold just as an example, gold company, it's priced US dollar 3,800. If it's Canadian mine, they're paying Canadian labor costs. Their costs are in Canadian dollars. This is a great enhancement to their margins, in addition to whatever the commodity price is doing. So that's kind of how we think about it.
But I want to go back to why are you staying away from Canada?
We think Canada is in a recession. And we think this recession is going to get worse. And the capability of Canada to get itself out of it is very, very hard. It's all based on moving money around from the federal government to subsidize, et cetera, et cetera. We just saw Carney's deficit projection now, I think $60 billion, which was much higher. I don't know how we're going to get out of this unless we export. So we want to be in the things that are exporting.
So, if we're in a recession, which certainly the economic data has not been supportive on jobs and GDP, but we're getting rate cuts. What do you think of these Canadian banks? You mentioned you don't own them. They're at an all-time high, and the domestic Canadian banks are an all-time high. So it's one thing to say, like TD is at an all-time high. Yeah. It's got that U.S. footprint, but it's CIBC, it's national, and they've had a tremendous run.
Yeah, and the old expression, you can't dance with all the pretty girls. We had other girls that we were dancing with, so we didn't feel like we missed anything. We took.
But you sounds like you wouldn't add here.
Oh no. Right now I would be more looking to an insurance company than a bank because the yields are comparable, and you get a little bit more global exposure through the insurance plays than you do at a domestic Canadian bank.
Okay, this segues us perfectly into the mailbag because we've got questions on exactly this topic. Let's get into it. All right, our first question in the mailbag is actually on those insurers. We got a question from Instagram, Servinos on Instagram. I think I said that right. What is your best pick in the insurance space, Lyle?
Well, right now we don't have a best pick. We don't own any insurance companies. However, we are looking at them, and Manulife is intriguing. Manulife had struggled for a decade, if not more, and it's starting to make a turn. What makes Manulife quite interesting to us is this exposure to Asia. It gives me a backdoor way into the growth of the Asian economies that I can't find really elsewhere in Canada. So that's the one that sticks up there, and its yield is pretty darn good.
One of the places people do go for yield in Canada is the pipelines. And they've had not only a good yield, but they've had a very nice year, both Enbridge and TransCanada sitting at all-time highs. Do they fit in your, what's the bucket, the comfort bucket, the dividend paying?
The dividend comfort bucket.
Yeah.
There's a little bit of growth associated with it, which is, that's what is it, icing on the cake kind of thing. You forgot South Bow.
Yes,
yeah, that's
spin-off.
Like we bought that with an 8% yield. That's great. Again, cost of capital. Let's go back to it. What is the long-term return on equity markets for the next 10 years? It's not going to be 10%. I doubt if it's going to be 8%, 6%.
That's
maybe.
what it typically does, though.
Typically it is, but people's expectations are very high. And if I can get that 6% bird in the hand, I'll take it. Thank you very much.
So would you feel comfortable continuing to add to these names?
Actually, the name I'm looking at, we've got 3 to 4% positions in each of them. That's a
max.
We're up there. Pembina is an interesting name that I've been looking at recently. I haven't bought it yet, but that's one of the names that hasn't rallied the way an Enbridge Trap and Sobo has.
What do you think is interesting there? Like typically when it lags, people say, well, it's not participating in kind of the momentum of the group, so it's not as attractive.
Great. No momentum, less risk. It's the momentum ones that are the risky because they're going up $1 every day. That's one way. But Amber, what does Canada have that the world needs?
Energy.
Yes. And we have one other thing, and we still haven't figured out how to get it. We have water.
Oh, okay.
So how do you play energy and water over a longer term? And that's where the pipelines come in, because they're going to take our energy and move it to ports. I mean, again, the politics have been awful. We really have wrecked Canada because we didn't build pipelines. And we're shipping our gas to Americans so they can LNG it and send it to Japan or Europe. This is all going to come to the benefit of people like Pembina, people like AltaGas. I mean, that's one of the names we can talk about, but it's one of our favorite names because I got on the East Coast, I got the server farms, and on the West Coast, I've got this LPG export facility that can continue to grow to take our energy and sell it to Asia.
Okay, so Pembina on the watch list and AltaGas you do own.
Oh yeah, we own that one. Yeah, I'm a little nervous about that one because we bought it with a 4.5%, 5% yield. Now it's 2 and change. It's had a great run.
Which only matters, I guess, if you're adding here, right?
Yeah, exactly.
If you bought it at 4%, that's still what you're getting. Yeah.
As Leon Fraser was a shop I used to be the CEO of, and we had George Fraser. George Fraser had a client that came in one day, and the client had 50% of his portfolio in 2 bank stocks. And I was like, oh my gosh, how do you explain this one to the regulators? And it was very simple. Just because it got big, do you want to take, if I explain to the regulator, that's 25%, that's too big a position. Well, why is that too big? Well, it's too much risk. I said, so you want me to sell it down to what, 10%? Take a massive capital gain hit, lose all that income. So you're telling me to take a risk by forcing the stock down. I'm going to lose all this for what? These are great companies. Anyway, that's the issue. You don't sell good dividend paying stocks just because their yields have fallen. Hold them on. And the dividend grows, you're good.
Okay, so but that doesn't apply to the Canadian banks because you don't like them. Well, but that applies to Alta.
It applies to any dividend-paying stock.
Anyway.
I'm just wary of the Canadian banks because they have been the purveyor of credit to the housing market in Canada. And the housing market in Canada is very dicey, and that's an optimistic way to look at it. Why own those that own all the credit being provided to them through mortgages?
I feel like that's going to answer the next question that we got on REITs. This is from Corsica Music on Instagram. Do you have any REITs that you like to invest in? You like dividends, but I
don't own.
We don't want to touch land in Canada.
No, but it's interesting. So I used to run a REIT fund. We used to have an internal REIT fund at Forvest, and I got to know the industry, quite well, and learned all the companies and all the rest. That is a sector that possibly has bottomed out. And so, where are we getting leadership? So we used to have our theme in the fund was beds and sheds. You wanted to own apartments, and you wanted to own sheds, which were basically warehouses. Beds and sheds are kind of out these days, but senior housing has been hot, and I don't see that going away as the baby boom generation ages. So I can see that being an attractive area, but it's moved, but not too bad. The one that I've been absolutely fascinated with is Primaris, which is the retail REIT.
Yes.
I know the CEO quite well because he was an analyst when I was a PM, and we just became good friends over the years. They got a really interesting story. It's basically retail in the non-big centers. And what we learned
which would sound like that's the worst place to be.
Precisely
they just bought. I know they just bought by this mall I used to hang out as a kid, the Lime Range Mall in Hamilton.
Yeah, and the reason is, think about the people moving out of Toronto. Forget the immigration coming in. There's a lot of wealth that's moving out of Toronto because you sell your Toronto house, you can buy 3 in most places in Canada. That's where the malls are, and that's where the growth is. So it's an interesting story. Plus, they are consolidator of all the retail investment that was made by the big insurance companies who need to get out.
So you own it, or you're looking at it?
No, I looked at it hard, and I keep getting ready to pull the trigger, and I just haven't done it.
Probably because you're quite bearish on Canada.
Yeah, I know that kind of is the prod under my tail. Like, what are you doing?
Yeah. Okay. We've got some questions on commodities now. You kind of flicked at Teck Resources. What do you think of Teck for a medium to long-term hold? This one coming from Sterlias on Instagram. I don't know if I pronounced that correctly, but Teck, of course, is trying to do a tie-up with Anglo American. So that's something to consider as well. But, would you like the combined company? How do you think about that?
Yeah, when we bought Teck years ago, we've held it through the piece. Bought it lower, probably bought some at 70. I think it's now trading at 60. As a copper play. Copper is one of the solutions to the world's problems with energy. I can't see demand disappearing. And that is the number one reason we own Teck. They sold off the coal business. They got the capital. Basically, they paid a little bit of a special dividend, bought back a lot of shares. They got the balance sheet all cleaned up. And now it's a pure copper play. Copper's the place to be. So we like it from a real top-down perspective. This Anglo merger, I think, is good because it gives them more market cap. And in this world where momentum and ETFs flow to where size is, Teck will benefit from that. But the long-term demand for copper is fantastic. And recently, there's been concerns about a surplus, but we just had the mining accident at Freeport's mine in Indonesia, the Grasberg operation. That really takes the surplus out of any late 25, 26. So copper's got a life.
Do you think there's a risk that it doesn't get approved?
I haven't even thought about it. You know what? To me, it put a bit of a floor in. So Teck had struggled. They had all kinds of issues with respect to QB2 in Chile, and that really took the stock down. It became a non-favored stock. This Anglo thing put a little bit of fire behind it, and now you've got the copper price going up, and all the people that sold it are maybe going to buy it back. I don't know, but I think anybody who wanted to sell it has sold it. Therefore, there's more upside than downside risk.
Nat gas is another sector you've talked about. Yeah. And on one hand, it seems like there's a big picture thesis for nat gas. Mm-hmm. And on the other hand, there's the reality that, nat gas prices, particularly in Canada, are languishing. We got a question on whether nat gas stocks are a buy now, asking specifically about New Vista or ARC Resources. Do you have thoughts on either of those or the space? The
space. Let's go back to that, again, that theme. Buy the gas in Alberta and ship it to the East Coast or the West Coast. Now that we now have export capacity in Canada to produce LNG with our gas. I mean, this is fantastic. That puts a bit of a floor under the AECO price, which is what Canadian producers get. So that's a long-term positive. There's lots of talk about now building more of them. Heaven forbid we might even get one on the East Coast. I mean, we won't talk about that. But gas, I think, has put in a bottom. When it comes to names, we looked at those. When we acquired our gas position, it was a while back, and the names that we had looked at, Tourmaline, for example, is a name. It's the big guy in the block. What they're doing.
I'm glad that you brought up Tourmaline because everybody loves Tourmaline. Everybody loves Mike Rose, but the stock has taken a bit of a hit. It's perked up recently, and I just saw a downgrade this morning, and I'm pretty sure it was from the analyst at TD, calling into question, well, two things, calling it expensive, but that they've got big spending plans. And part of Tourmaline's attraction, you know this, is that they love to give you those special dividends and basically suggesting, given how much of their cash is going to be eaten up by these big spending plans, that in the long term could be correct, that maybe investors won't be rewarded as much by those special dividends. I'm curious on your thoughts on why is the stock kind of in the penalty box right now, and whether you agree with anything that the downgrade says.
Yeah. I mean, I didn't see the downgrade. It makes sense that if you have a time frame that's short, and here's the question that, again, I used to work on the sell side. There is no time frame with analyst estimates in terms of their recommendations. I'm going to downgrade the stock. Okay, great. Good for you. Because I don't know what the time frame is. If you're buying it for a 5-year time frame, fantastic. Double downgrade it. I can buy it more cheaply. I look at a company that's got a good capital allocation discipline. Again, it goes to that cost of capital. They're returning money to shareholders. That which they don't return, they're willing to invest in opportunities that they see. And the Canadian gas market has changed dramatically with the LNG plant opening up. So they are the biggest player in the Canadian kind of pure play gas space. It's the go-to name. When people decide to go to it, it'll go.
Do you own it?
Oh, yeah.
You own it. But you're bringing a preferred name to us in ProPix, and you're not going to mention it now.
I'm not going to mention that. Nope.
Because that's coming up in just a few minutes. It's called the T's.
Oh, all right. Can we go 3 P's and just leave the T's there?
Yeah,
that's ProPix,
and
and the third.
We'll talk about it. No hints. Okay, gold, such a big part of your portfolio. You said 12% of your portfolio. We got a question.
No, it's higher than that.
It's higher than 12.
It's over 20.
Oh, 12% was how much of it is in the index.
Yeah.
So you are overweight.
Yeah.
Big time.
Yeah.
Bigly.
Calamity protection. Yeah. And I mean, you buy calamity protection for fear that everything else is going down, and it happened to go up. So I mean, we got the double effect. It's the perfect portfolio diversifier.
The question is, how are you going to express that? And we got the questioner, Instantaneous Grammar on Instagram, put a lot of smaller cap, B2 Gold, Seabridge, Orla Mining, First Quantum. Do you like any of those smaller ones, or are you expressing it in a larger cap view?
This is more of a top-down play. You want to play the big guys. You want to go that way. So our pecking order, our biggest holding in the portfolio, and it's becoming an issue because it's now getting close to 10%, is Agnico Eagle Mines. The good news is we didn't have 10% when we started. It was much
and that's been a winner.
Oh, it's outperformed. I mean, I can't say it's outperformed NVIDIA, but it's outperformed NASDAQ by a long shot. It's a great company. Like, it is a great company. I've followed that company for many of the years I've been in the business. The way they do their business, the thinking they have, the forward thinking, the capital discipline, it's a great company. It just happens to be in the gold mining business, but it's got the discipline of being a good shareholder-friendly company. So that's our biggest holding.
Over the past year, it has outperformed NVIDIA and the NASDAQ.
Oh, well, there we go.
Not quite over the longer term.
Now I'm in trouble.
It's caught a hot hand. Agnico has doubled in the last year. NVIDIA's only up 50%.
I feel better.
And the NASDAQ's only up 25%.
And the banks are only up 25%.
There you go. So that was a home run.
Yeah. But we haven't, we've trimmed it. As it gets close to 10, we're trimming back. Doesn't pay enough dividend to let it just run and kind of pay the dividend. It does pay a dividend, though. And the dividend it pays is not that far away from the S&P 500. So I get protection and I get income.
The S&P 500 dividend yield is nothing, almost nothing. But yes, you'll get your 1% dividend yield from the S&P and Agnico. Do you give any thought to Barrick? Or Newmont, for that matter? I'm only thinking that because they both announced CEO changes, although Barrick's was a big surprise. Mark Bristow leaving after 7 years immediately.
Again, Agnico went through the CEO change a while back when Amar Al-Joudri came in, and I've been there, done that. I haven't been in Newmont in Barrick because I got a really good one. It's a big weight. And in addition to, when you think gold stocks, they're kind of different. So you've got the operator, you got Agnico. We most recently acquired a silver producer because it's kind of late in the cycle. Silver has a run. But then you got the streamers. And the streamers participate differently in the gold sector. They don't actually get operating cost benefits because they're getting a percentage of the revenues. So we own both Wheaton and Franco Nevada. So they're part of our gold exposure.
So you'll go with the large caps, the stable names like Agnico Eagle is like as blue chip as it gets. You'll do some stuff around the streamers, but it sounds like you don't want to get cute with the miners, the junior miners.
I've got a lot of gray hair from chasing junior miners in my younger days. I think I expedited the trip. So don't need. Rick Rule spends time understanding. I used to go to all these gold conferences. I got to know everybody. And you know what? I got Agnico. It's a great company that happens to be in the gold business. That's good. I think the streamers, though, are quite interesting because they're a little bit lower risk. You get more direct participation in the gold price without having the operating cost risk. And that's important.
And those royalty companies in mining, basically, they finance a project, and then in exchange, they get a cut of the output, which is a royalty.
But you mentioned one of those names on your list was
Orla?
First Majestic.
No.
Oh, not First. I'm sorry. The copper mine in
First Quantum.
First Quantum. We own First Quantum because Franco Nevada has a royalty stream, and Franco Nevada stock got banged big time when First Quantum got shut down by the Panamanian government. And now as it gets better, we think we got a little bit more of a kicker into Franco Nevada. I mean, it's not the pure play, but heck, it's good enough.
Yeah, First Quantum really came back. But I don't think they're minded.
Not yet.
Still offline.
Well, you know, markets, they discount into the future.
That's right. They're future looking. Let's talk uranium.
Sure.
It's just running. Cameco, all-time highs.
That's the only uranium name that we own. And
so do you get nervous about a stock that has gone parabolic?
I always get nervous about parabolic. However, when you think about that, again, go back to that picture. Gas is a transition ultimately to nuclear, and Cameco is nuclear. Like you get the yellow cake, but that acquisition of Westinghouse was, I think, a real gem because they're arms manufacturers now. You know, the world wants uranium, the world wants energy. You get it through uranium, but they got all the equipment, they've got all the patents, they've got all the intellectual property to take yellow cake and turn it into kilowatts. And that's pretty exciting. So we own it, we've liked it, and I always get a little nervous. And, MacArthur, they kind of said they're going to take some production down, but we don't own it for the near term. We're looking at it as the play at the end of the natural gas transition.
Well, how do you think about valuation on a stock like this? Like is it a traditional PE?
It's a cash. You're valuing it on future cash flows. And so when we bought Cameco, we were thinking about, okay, so the stock was down, uranium prices were moving up, and that was positive. We didn't see any reason that uranium prices would go down in this world now that needs more and more electricity. So that was a theme. So, earnings momentum was positive. The Westinghouse thing, when you really kind of factor in, it's pretty good cash flow coming out of that. And they just announced in their most recent, last quarter, or 2 quarters ago, some of the cash that's coming out of Westinghouse. And we see that as a cash machine.
Hard left with our last question in the mailbag. It's on Constellation Software, which has been just a fan favorite. It's a beautiful compounder since going public. And it is on the verge of a very rare annual loss. The founder, surprising everybody, stepping aside due to health problems, Mark Leonard, has built this tremendous kind of quiet consolidator in Canada in the tech space. Do you own it?
Nope. And it's a regret. With 2020 hindsight, I missed it years ago, and you miss it once, and you kind of think...
You can buy it now. It's a 52-week low.
It's 30% off the high. One of the issues I've had with Constellation is growth by acquisition. And I've gray hairs that I got from not owning or owning too many junior stocks. Canada's always had some very interesting growth by acquisition companies. Remember Laidlaw, Phillips Environmental, Lowen.
Valiant.
Right.
That's my vintage. That's my vintage.
All right. Another one. Like when they blow. And everybody owns Constellation. And one of the difficulties I've had as an analyst is it is a hard stock to follow. They don't really provide a lot of information. And I don't know. Anyway, I missed it. I didn't want to do a lot of digging into any reports and stuff like that. I know the space from days gone by. There's a company called GIAC, which was in the same thing. It was kind of the original consolidator in this space. Mm-hmm. Anyway, I never owned it, and I didn't want to chase it.
All right.
I
can't own them
all.
Well, we're going to find out what you do own, what you do like, your highest conviction ideas. It's time for Pro Picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information.
Pro Picks. All right. Should we start with the P?
Let's start with the P. This is on PETO exploration. We promised a natural gas name. This is a natural gas name. Tell me why you like it.
Yeah. Again, this is one we've owned for about 2-3 years. We bought it with a 14% dividend yield. As I was thinking, okay, so if I take a 2% position and it's paying 14%, that's 0.28% component of a dividend in the total portfolio. It's worth taking a 2% shot. The market did not like it because it had a lot of debt, and they've worked their way out of the debt. The dividend is still 7%. They've got a good capital discipline. And so I'm a happy PETO holder.
They're a hedge. They believe in hedging.
They believe in hedging because they had so much debt.
Yeah.
And that's what you got to do. You have to do that. And so they did it, and now they're getting out of it. And now they'll get to benefit. And again, the natural gas price hasn't run away. So they can now get benefits of, let's say, $4 eco gas. More flows to them than not.
So I've been reading about these issues with Canadian natural gas, that there's just a surplus. Everybody was producing in anticipation of the LNG terminals being functioning and up and running. And they've had some growing pains as they open up. And so that has led to the situation of kind of a surplus. And that's obviously weighing on prices. Does that deter you at all from this thesis?
It makes me a little nervous, but it's not destroying the ultimate need for natural gas as a transition instrument. Gas prices are low in North America. That deters drilling. And the best solution to a low commodity price is a low commodity price, right, because they won't put capital in the business, and these businesses are more disciplined.
Calamity, Comfort, or Children? Which bucket is this?
It started as Comfort, and it's still Comfort. It's the 7% is my total return on equities.
Yeah, there you go.
Yep.
Sprott.
Yeah.
Goodness. We've actually had a few people recommend it. I think even Rick Rule recommended it.
He's long in there for
Yeah, that's right. Yeah. But a few months ago, we had a gentleman, James DeValos, come on when it wasn't like kind of moving. So this one has kind of been making its way onto people's radar, and it's doubled in the last year. It's a great resource exposure, I imagine, is why you like it.
Yeah, it's financial exposure to the resource sector. It's got leverage. And when we bought Sprott, I'd done a bunch of work just looking at their precious metal ETFs. Full disclosure, part of our gold exposure is actually Sprott physical gold ETF.
Well, that's what Rick Rule said. Instead of paying them a management fee to own their funds, just buy Sprott.
You buy that. You don't get the leverage, right?
Yeah.
And so you buy Sprott Inc. for the leverage off. And all you got to do is kind of see what the price of gold is doing and then see the number of shares outstanding. And I think they get a 40 basis point management fee off that. That's almost free money because the cost of the operation to them, they don't have to hire an additional analyst. It's kind of a no-brainer. So I got leverage to bullion price, I got leverage to the silver price, and leverage to the uranium price. So I get a three-way leverage off of silver, gold, and uranium.
I mean, they really had to bide their time and wait years for this, right? As they were creating these funds and these ETFs to get exposure. And now it's being rewarded and that their assets under management are exploding higher.
Yeah, and I'm hoping to see a nice dividend increase out of them.
Now, I saw a downgrade, your favorite, talking about sell side.
Yeah.
This was a few months ago, but one of the things that caught my eye, and obviously a downgrade in July, like they left some money on the table.
Sure.
The stock just continued to go higher. But it did talk about valuation. So I keep coming back to this, that it's just trading at a premium to alternative asset manager comparables. And I imagine that's even more so, given the stock is higher than it was in July.
Yeah, and we didn't buy it as an asset manager. And, the hard part is, what sector does it belong in? And some people get hung up. I don't really care. I mean, again, to me, everything is an investment. Some are, we call them preferred shares. We call them government bonds. I don't get hung up on that. I've got income producing, I got growth. I always look at securities in terms of what they can do. When I looked at Sprott, it was just a fascinating play, sort of in financial services. We call it a gold company. We got to put it somewhere. So it's in our materials allocation if we had a materials allocation.
I mean, I'll tell you why I find it a tough time personally investing in commodities, because the cycle ends at some point, and the business, when the cycle ends, just won't be as good. How do you guard against that? Or what do you say to yourself to be okay with that?
I totally concur with that. When cycles turn, it gets darn ugly. And it has been really bad for 25 of those 40 years. But the companies have gotten better. They don't make the dumb investments that they've made in the past. You know what I'm perpetually amazed at in the gold run that we've seen over the last 2 years, there has been a dearth of new issues of junior mining companies. I mean, we used to get those things every minute. The brokers would always come up with a deal because there was another piece of like nothing. In fact, you're seeing the large cap companies, Newmont, I think it might have been Anglo actually, selling interests in their smaller companies. That's capital discipline. So these companies are coming out of a world where nobody bought them because they were crappy capital allocators to they're not that bad anymore. So there's a tailwind behind them.
Okay, let's end with your pick. It is a resource pick. It's silver. We haven't talked too much about silver, but that has also been a tremendous place to be. Silver is up 40% so far this year, and your pick, First Majestic, has doubled so far in 2025, but that's only taking it to the highest since 2022. So it's not even like it's all-time highs and has exploded. What do you like here? Is it just a continued call on silver? Is there something specific to First Majestic?
It's more call on silver being. So when you look at a precious metal cycle, gold tends to run first. Silver is the catch-up, but when it catches up in multiples. So we didn't have any direct silver exposure. And so I was just looking around, where do you get it? I've known this company, again, for years. I'm always intrigued. They have a mint where they do their own processing of their silver ore. It's kind of neat. It's a retail thing, but it's different. They have a policy of paying out a percentage of their revenue. I think it's like a tiny amount as a dividend. And I can see these revenues going up as the silver price goes up. Their mines are in Mexico, not A++ jurisdiction, but not bad. And I like that. And it's well managed. It's a company I followed for years and years and years, and I needed to get a silver name on it. It was a coin toss between that and Pan American, which is another good quality silver producer, but I picked First Majestic.
You talked about these companies not going out and doing stupid deals. They just did a huge deal a year ago.
And they got dinged.
Gato Silver. and they got dinged. But like from the results this year, it's clear that that's already paying off.
Exactly. And see, the first mentality is they bought a deal or they made a deal. They bought a company, got to get out. It's terrible. Another mining mistake. Oh no, after you've been, beaten over your head with investors' bats because you've been a poor capital allocator, you're much more cautious. And so I kind of like companies that are making acquisitions in the commodity space, even at this time. And it's not just silver. So it's an interesting time because of the discipline of capital deployment.
Lyle, thank you so much. I've loved chatting with you.
Amber, this has been great.
Now, before we tell you who's coming up on the show, let's get to our ETF Minute. Canadians, we love our bank stocks, and for pretty good reason. They've delivered decades of strong returns and stable dividend growth. Now, if you're looking for a simple, low-cost way to own all 6 of the big banks, Hamilton ETFs has offered the Hamilton Canadian Bank Equal Weight Index ETF. The ticker on that is HEB. And right now, there's no management fee until January 31st, 2026. Equal weight means that you're not picking favorites. You're just owning the sector. And unlike some financial ETFs that mix in the insurers, HEB is banks only. This past earnings season showed 3 things. The banks are keeping expenses under control, provisions for credit losses remain steady, and profits by and large came in ahead of expectations. Now that's not bad considering we're in a challenging economic environment. Dividend increases didn't happen this quarter, but may happen later this year. Now, if you're optimistic about the sector long term and you want to dial up your exposure, Hamilton also created the HCAL. This is the Hamilton Enhanced Canadian Bank ETF. Here's the key difference. HCAL owns the same equal weight bank portfolio as HEB, but it adds modest 25% leverage using margin. Now, this is not your 2-time or your 3-time leverage ETFs that you may have seen elsewhere that use a lot of complex derivatives. This is a straightforward, modest borrowing strategy, similar to what many individual investors already do. But because Hamilton has scale, they can borrow at lower rates, making the HCAL an efficient way to boost exposure and enhance your dividend yield. But of course, leverage cuts both ways. It can amplify your returns in strong markets, but it can also magnify your losses during a downturn. Now, having said that, actually, the HCAL has historically been a strong long-term buy and hold ETF. It's backed by a consistent track record of the Canadian banks. And importantly, Canadian banks already have relatively low volatility. So by diversifying across all 6, HCAL smooths that out even further. And after adding the 25% leverage, HCAL's volatility hasn't been meaningfully different than owning a single Canadian bank stock. For more information on HEB or HCAL, visit HamiltonETFs.com or the link in the show notes. And remember, always do your own research and invest according to your own personal risk tolerance. Now, coming up on the next episode of In the Money with Amber Kanwar, we've got Laura Lau of Brompton. She talks about North American stocks, so get your questions in now. You can email us at questions@inthemoneypod.com, visit our website, inthemoneypod.com, or find us anywhere on social media @inthemoneypod, and we'll see you on the next episode.